Hi there, and welcome to Talk ETFs, ETF.com's weekly video series. I'm Sumit Roy, Senior Analyst here at ETF.com, and this week I'm talking with Dan Petersen, ETF Product Manager at IndexIQ. Dan, welcome to the show.
Thanks for having me.
Absolutely. So, Dan, I want to talk to you about currency hedging ETFs. I've looked at the flows recently, and it looks like interest is picking up for currency hedging ETFs, and they appear to be on the rise again, at least on the surface. Why do you think investors are interested in this category again? Why are they taking a fresh look at these ETFs?
It's a tough answer there because it might be a little unfortunate, and that's because even though we have everybody has the disclosure everywhere not to look at past performance in terms of future expectations, most do. And what happens is when you look back 1, 3, 5, 7, 10, even 15 years, you want currency hedging. You would have wanted currency hedging, I should say. And that's because the performance has done well, because generally the US dollar has strengthened. When the US dollar strengthens, that means that relative to foreign currencies, the foreign currencies are weakening relative to the dollar. And in that sense, you don't want exposure to foreign currencies because they're not helping the returns. So by hedging, you're taking away that headwind of currency weakness overseas. So that's why I think a lot of people are revisiting hedged currency exposure. I would just say that it's a double-edged sword, right? But it tends to be a mean reverting exposure, and it tends to provide volatility to portfolios. Currencies do. So hedging will reduce that volatility, and in that sense, it's interesting to take a look at. But you do also want to be aware that currencies can supplement returns.
And if an investor leaves their portfolio unhedged, how much of an impact could that have on their equity returns?
Quite a bit. So as I was saying before, leaving those exposures unhedged has provided a bit of a headwind to equity returns overseas. 2022 is probably the best example of that, where currencies took away from returns more than the equities did, right? So you actually wanted to be diversified with international equities in 2022 because international equities were down quite a lot less than the S&P 500 or any domestic equity downside. But currency exposure more than doubled the downside of those foreign equities, making your total return in 2022 very similar to what happened in the US. So it didn't really provide much diversification if you left everything unhedged. So it can have quite a toll on exposures, and again, provide additional volatility. So we find on average that currencies can contribute upwards of 6.5% on average, either help or hurt the local equity return. So that's quite a bit.
That's incredible. So if I recall, the last time we saw, this big interest in currency hedge ETF was back in 2015 because we saw a lot of movement in the dollar. Was that the last time we saw it? And what's going on this year with currencies in 2024?
So currencies again are picking up in volatility. In 2015, when we had first launched, I'll start that over again. In 2015, when we had first started the strategy, it was definitely something that was a topic of conversation because U.S. dollar strength and particularly Japanese yen weakness was all over the headlines in terms of intentionally devaluing their currency in order to spur economic growth. So it made sense to look at Japan with a hedged lens, looking bullish on the equities and bearish on the yen. And currencies generally have detracted from returns since then, which helps anything with any level of hedging. So we've seen currencies go up and down over that period, but overall net down, which means you wanted the hedge in place. And this year, again, there seems to be a bit of a headwind if you have currency exposure. 2020 was the last year I can remember that you wanted currency exposure. So again, it's really kind of depends on what year you're in, and it even depends at what point in the year you're in, because those currencies can move around 1,000 basis points in a year, no problem. And again, net, give or take 6.5% in any given year.
That makes a lot of sense. I want to ask you about a specific ETF before I let you go, Dan, and that is your ETF that has the ticker symbol HFXI. I know you've mentioned that this is kind of, the ETF that uses the hedge of least regret. Can you explain what that means?
Right. So this is what we feel to be the most passive way to attack international exposure. We have been talking this whole time about hedging, about not hedging. And that is a decision that can be made, and that could add returns or take away returns. So it's an active decision. Do I include currency or do I not include currency? Or is there a passive middle ground? And that's the hedge of least regret. It's a 50% hedge. What we're literally doing in the portfolio is taking away that inherent currency exposure to half of the extent in the portfolio. And it's an easy solution for anyone who wants to just allocate internationally without thinking about what their view is on currency. Do I want currencies to go up and supplement my returns, or am I worried about currencies going down overseas? And do I want to limit my downside by having less exposure? This does both, right? You get some of the upside by having 50% of the exposure, but you also protect on the downside and lower your volatility by not having 50% of the exposure. So again, it's that hedge of least regret. It's a way of saying, I'm passive in this space. I want market cap weighting, and I don't know where currencies are going. I don't want to have to deal with that in my portfolio. So is there a way that I can have a passive exposure and take that middle ground approach with a strategy?
Fantastic. Well, a ton of great information, Dan. Thanks so much for your time.
Thank you, Sunil.